So good afternoon, folks. This is Alok Jain this side. I'm also joined by my partner Parikshit, who takes care of a lot of things at Weekend Investing. And we are going to have this session in the format of having a small presentation. We'll give you some historical perspective on how markets have behaved uh, during and after volatile periods, and then of course it's all going to be open for Q&A session. So we'll wait for maybe another minute or two, and then we'll go forward with the session. So it'll be great if you can introduce yourself in the comment section, where you're logging in from, whether you are already a part of weekend investing. Hello, Aman.
It would be nice to know if you are a weekend investor. Please type weekend investor if you are invested in any of our strategies.
Just 50, 60 more seconds and then we will start. Hello, Purv. Hello, Mr. Anil. Hello, Sarat Chandra, Ajay, Mr. Aman, Mr. Dinesh, Saiharin from Melbourne. Aman is from Ahmedabad. Very nice that you could make it on a Sunday, Saturday afternoon. Hello, Karthik. Hello, Rudra. Hello, Ranjit, Sai Chand, Manoj, Sachin. Very nice to. Oh, from Germany as well. From Spain. We've got a very international group here going, from Australia to Dubai to Spain to Germany, Kolkata. Bhupender from Pune. Rudra is from Kolkata. Sandeep Patil. Hi, how are you? Data Speaks from Bangalore. Newton from Kolkata. Very nice to meet you all, gentlemen. Siddharth from Bangalore. Hi, Faiz. Hello, Deepak. So, Parishit, I think we should start now. We have a good number of folks already in. Chandan, hello from Ahmedabad. Anupam from Bangalore.
Yeah, we
Jitin
can get started.
from Mumbai. Hi. So, good afternoon. Good afternoon, ladies and gents. Thank you so much for coming on a Saturday afternoon on a short notice. We thought so it would be nice to touch base with the users on a exclusive one-on-one basis on a YouTube live, and hopefully we will be able to try and do this on a monthly basis. Every last Saturday of the month, maybe we can try to do this. So essentially, the format of today's meet is that I'll give a 5 to 10 minutes of presentation, and then predominantly it will be Q and A's, whatever you may wish to ask, whether it is about the strategy, about the market, about small case products, about anything that you may wish to ask, and I may or may not be able to answer everything, but I will try my best. Thank you so much for joining. We have a good 80 plus people already joined in. So let's start here. So navigating volatile periods in the market. So let me first get the context here, that some of you have been, at least on Twitter as well as in communications, feeling very very frustrated about the market. That the market is not doing well, market is not going up, and the market has, kind of stagnated since October 21. So we are, almost 18 months into a period where the market has not gone anywhere. um, is this normal, is this new, is this, does it, has it happened in the past? So it has happened several times in the past, and if we go back and look at maybe the history in the last I think I have a long term chart also somewhere, yeah. So if we look at a long term view of the Nifty, and this is a more than a 30-year chart, what you will see is that there are periods where the market doesn't do anything. So after the 92 boom here, after the Harshad Mehta boom, you find that till 99 markets were reasonably dull. Then again, after the 2000 boom, the next 3 years were very dull. Then after the 2008 2007 jump from 2003 to 2007, the fall was very dramatic in 2008, almost 65% gone in 2008 itself. But the comeback was equally severe. And for the next 6 years, so from 2008 January till about 2013 end, uh, almost 5 years, I would say, 5 to 5.5 years, the market really did not go beyond a certain level. It did, bounce twice, went down, came back up, then went down again, came back up. And then there was the election rally in 2014, which carried out into some part into 15, and then there was a correction here. So another year and a half was gone here. And then from there onwards, 16 onwards, we've had a reasonable run with some blips in 18, COVID blip in 2020, and of course, since the last 18 months, we have not gone anywhere. But overall, if you see in the last 30 years, you will find that not even two more than two occasions are there where we had even 2 years of a downfall. So just these two blips, this one and this one, are two consecutive down years. That is the worst case in terms of consecutive years down. In terms of the market being down and staying down, this was the worst year in the last 30 years, 65% down on Nifty, but a equally ferocious run in the next 2 years. So the worst case scenario here was that you were down for 2 years at a loss. If even if you bought here at the top in 2008, you were back at even at least in 2 years. Then again in 2011, when the market dropped, you were back at even and more in 2013. When you were stuck here at 2015, you were back at the same point in 2018, 17, sorry. And then when you dropped from March 2020, you were back up within 6 months beyond that limit. So this point that we reached in end of 21 and beginning of 22, we've just spent maybe a year after that. And given that the past history is such that within a couple of years, we will, the likelihood and the probability of that point getting breached again is very, very high. I mean, 30 years, 35 years of data is not a small, period of data. And what you can see is that regardless of whatever is being thrown at the Indian market, it has a resilience to come back, because that is the sort of the inherent growth that is there in the system, regardless of whatever political turmoil has been thrown in, regardless of whatever global turmoil has been thrown at it, regardless of high interest rates, all kinds of policy debacles have happened in this entire era. So there is a inherent growth uh, phase in the Indian markets, and many analysts have recognized that and have called that India has a great runway for the next couple of decades. Yes, in the long term, everything is looking very rosy, but what about the shorter term? Because we need to also see what kind of pain we go through when we go through a shorter term journey. So now, if you see the gains from March 2020 till October 21, we had a humongous rally. I mean, I don't think I remember a rally this ferocious ever in the last 30 years. From going from nearly 7,500 on the Nifty to almost 18,500 on the Nifty within a span of 18 months. Now that means that the market went up almost 150% within a span of uh, three biannual periods. So 18 months, is where we've clocked 150%. Now what the market is doing since then is digesting those gains. So the market has not fallen net, it has not fallen off. We were close to 18,000 at the beginning of this, you can say, range bound market, and we are still very close to it. We're just about maybe 5% away from 18,000. So net, and versus a lot of other global markets, I think India still stands extremely strong. And from that perspective, it is showing that relative strength, despite FII sales, despite the headwinds that are coming from the global markets. And that at least gives me a lot of confidence that as and when there is more tailwinds from the global markets, as and when there is more tailwinds from lower inflation and lower pricing, our markets probably are going to be the first to move again. Because of this, emerging market funds have to sell in proportion whenever they're selling off emerging markets, and India as a proportion of that fund needs to be sold off. Hence we are getting a lot of these FII sales, because FII sales have dramatically increased in the last many months, and now of course it is coming to a point where they look like that they are abating. Of course, very early days, but that is something that's playing on. So essentially, the part of my thought process here is that if you're looking for returns in the equity market, you will need to look at business cycles, market cycles, and just one cycle and one part of that cycle is not good enough for you to say that the market is not doing well, because we have to see the context. Where have we come from in the last 18 months and where we were in the 18 months previous to that? If you join these two 18 months together, we still are at 150% points in 3 years. Even that is amazing. That's 50% CAGR. So we must never lose the context from where we are calculating these returns. Now, this is a CAGR chart of Nifty, and we had data from 2003. Not specifically why we've chosen that, it just that we had data from there. So what you can see here is that despite these huge drawdowns that keep coming in Nifty, if you are invested in Nifty post a certain period of time, your CAGR becomes very constant. Because of the longevity of your investment, the aberrations that will come, that the drawdowns that will come over time, and will get to be a part and parcel of that entire long averaging that you have. And hence you can see that while in the earlier years here you had a lot of ups and downs in the CAGR, the CAGR actually becomes very smooth beyond a certain point, because of your continuous doing either bringing in money gradually over that period, or just sitting over a longer period of time on that. So it is established that markets are very cyclical, and when we look at annual returns from the index also, you can see that they are very lumpy. So you had two negative double digit years, you had a single digit plus year, then you had a very huge lumpy 71%, and this is Nifty I'm talking about. Then you had an average of 2004, then you had some great 3 years of high double digit returns. Then you had a high double digit 50%, 51% of a negative year. Then you had a 75% gain in the year after that, and so on and so forth. So what you can see is that the drawdowns and the gains are very lumpy, and you cannot really extrapolate based on that I got 30% this year, I got 30% in the year previous to that, so next 2 years I should get 60% or something like that. There is nothing like that. You can get 27%, 6%, 31%, and then just have 2 bad years, and then get another one, and then have 2 normal years. So this is going to remain like this forever. This will not change. In terms of weekend investing strategies, also it has been very similar. So large and mid cap strategies, for instance, while the Nifty had a very nominal 3 years here, one very bad year, and then one extremely good year, and then one decent year, most of these strategies also had decent years of performance, and 1 or 2 years of either a negative performance or a flat performance. This one, FY23, has been extremely, I would say, below the what is the expectation. In many cases, we have not met the market expectation also, but in many cases, we are seeing that the crazy kind of returns that one gets when the market is in your favor more than makes up for it. So that is what you will need to see over a period of 3 4 5 years of time as to how things are performing. So Nifty overall has given a 0.6% negative for this entire financial year. Nifty next 50 has given a -8%. CNX 200 is down -2%. Some of our strategies are green, some of our strategies are in the red on this. In mid and small cap, also the same structure is playing out. Huge, lumpy few years and some really lumpy down years. What you can see and appreciate probably is that if you are able to avoid these massive lumpy down years, that gives us a huge boost in your overall performance over a longer period. So here you can see, for instance, MI20 doing a huge lumpy outperformance on the upside and avoiding these very large falls here. Again, 14.5% on mid and small cap and doing a 57% in that year. So you will not be able to predict how and when those lumpy years will be able to come, and you will need to stick to the strategy and persevere along with it and bring in your capital gradually if you are gradually moving into that. Again, in small cap only strategies, two reasonably bad years in 19 FY19 and FY20, almost -41% lost here in small cap index. And just look at this, the performance in MI25 and MI35, losing only 8% and 16%. So losing less on many occasions is going to really boost your upside when the when the strategy actually performs more than the market. All cap strategies also similarly, this 18 19 and 1920 period were the two periods, 2 years where nothing really gained, but then there was a one huge boom year, then there was a normal year, and now this has been a extremely red year, I would say, for MI all cap also and MI ATH. But given the fact that these are the kind of returns that can come in a up year, we can very well accept these years as down years or flat years. So essentially, what we are seeing here is that if we see the last 7 years of result on a rolling basis, if we see what is that period where we have not lost money ever in this last 7 years period. So over the index, that period is about 4 years. In any of the index, in any 4 year period, you've not lost money. In the strategies that we are running, in many of these strategies, it has been about 2.5 years. So the strategies have performed better than the indices, and a minimum of 3 years, but I would say 4 to 5 years is something that I would think that would at least make sure that you get some decent result out of it. Similarly on all cap strategies, similarly on small cap strategies. So essentially, just to sum it up without taking too much time out of the Q&A, no strategy so far has had a negative outcome in any 3 year given period. This is a given. This is the result audited by small case also. Come in with a mindset to stay for at least 4+ years. I would think 5 to 7 years is the ideal time for him to look at equity market investing on the long side, because the business cycles are such that it could take longer or shorter. If you get a great year as soon as you start, like a lot of people started in 2020 or 2021 and they got a great year to start with, I think that is extremely lucky, and you cannot expect that going forward every year. SIPs have been majorly been able to do much better than lump sums. So my request is always, don't bring in lump sums. Please bring in your capital gradually. If you've already brought in your capital, then you stay with the strategy and allow the strategy to perform. If you're gradually bringing in the strategy with invest more in SIPs, please continue to do so. Don't stop your SIPs, because the years where markets are down, those are the years to consolidate and to get your capital ready for that upswing whenever it comes. It won't tell you that it is coming. It will be a surprise every time when it comes. Nobody will be expecting it, and whenever it comes, it will surprise everybody. That is for sure. I mean, I've been saying this for a good almost 27 28 years. Every time a run comes, it surprises everybody. Again, try to increase your capital gradually, invest adequately. So expense ratio is something that you very well need to take care of. Please be aware of all the costs of each strategy, of all other costs as well. and appropriately plan for that kind of capital to come in so that your expense ratios can remain low. Ideally, lower than 1% is what I would recommend. Basically, best rules for best outcome: low expense ratios, regular SIPs, punctual rebalances. This is very, very important. A lot of folks are delaying their rebalances because maybe on that day they don't feel like doing the rebalance, or they may not like the prices. Please don't do that. That can have very detrimental effects sometimes. Do not delay the rebalances, and have a longer time frame in mind. This slide says 4 years, but I would consider maybe even 5 to 7 years as your effective time period. So I'll quickly open the floor now for questions, and then I'll answer them one by one and to the best of my ability. If in case we don't have time left after 1 hour to go with all the questions, we'll take it on email or something. No issues on that. Mr. DJ says, I have made lot of losses in all cap. All profits of last 3 years have been wiped away. Brokerage and small case fees of 12,000 are additional per year, not worth the effort. So where is the query? I can show you the 3 year chart of MI. Which one is this? MI all cap. And I think the data that you are presenting, I don't know, it does not match with the results that we have seen with many investors. So let me just quickly, uh, maybe open up the chart for you. Just give me a minute. I don't know how many of you have visited the weekend investing site, but if you haven't, please do so. Uh, we have a lot of analytics here on this page, and you'll have a lot of insights when you will look at this page from here. So if I look at the last 3 years of data for uh, MI, right? This is 3 years, right? Okay. So this is what I have for 3 years of MIMT all cap. Money should have tripled over the last 3 years. If you have any specific way in which you have invested, you can definitely let us know. But yes, I will admit that there has been a drawdown since January of 2022. As you can see here, the market has been devoid of momentum. But to say that the 3 years have not given any returns, that would be a incorrect statement in my view. Newton says you announced during Adani fall that there will be some in between weak balances. Can you clarify how will it be executed or special case like Adani crash? So post Adani crash, we have announced that we will have a special uh, midweek rebalance if there is any red flag that is found on any stock, or if there's any special announcement regarding any stock. So there will not be any regular midweek rebalances if a stock drops 5-10%. That is not the kind of rebalance that we are talking about. But if there is a significant need for any red flag stock to be taken out, we will definitely take a look at that. Prateek says, in fact, I invested in MIMT all cap and ITH2 as per weekend investing. Market performance is irrespective of strategies. I'm not sure what to do. So, Prateek, let us know when you joined the strategies. And of course, this data is available for you. Please match your data with this data. If it is off by a significant amount, do inquire from small case also what is the reason for that data to be off, if it is. But yes, if you have come in, which is the other strategy you said? MIATH2. Okay. So you can check MIATH2 also. Yes, it has been in a drawdown since October 21. So yes, again, you can see here that the high was 537 and now it is at 409 something. So the drawdown has been there. This is the result since the last 3 years. So if we just see from, let's say, August 21 is where we started. The ATH2 is down by about 22% since its start. That is the uh, metrics for ATH2 since the start. In the last 1 year, it has recovered ground in the sense of just trying to beat the CNX 500, but the period before that was definitely in a drawdown. So I think what I'm already saying is that this period of 18 months is has been a period where uh, to expect that momentum strategies will outperform is difficult because it has not been a sharp fall. Had it been a very sharp fall, I can guarantee you all these strategies would have performed because they would have moved either to cash or it would have moved to stronger stocks in the particular set. But what has happened is that it has been a very range bound strategy. So momentum strategies are getting that momentum and it is failing. It is getting that momentum and it is failing. So this is causing that whiplash in the results. And there is nothing wrong in that because this is a part of that strategy. And once that ideal conditions do come around with stronger momentum, this will make up within no time. I mean, as we have seen in the last 7 years. So this is not something that is new. We've seen, let's say, for instance, the strategies which have been running for 7 years. If you look at those, if I look at MI25, I mean, there has been drawdowns from 317 to 227, 30% drawdown, flat year, and then going back up and then going flat again. So there have been many cases where drawdowns will get recovered and strategies will start to go up. So the idea is that if you're saying I'm not sure what to do, you must make sure that you are therein for the long term. That in case you are gradually bringing your capital, please continue to do so. Do not quit. Do not quit a strategy when it is in a period where the environment is not aligned for it to perform. DJ says good research and no unwanted reshuffle and tension on weekly basis. I'm not sure what is the query, but uh, yeah, I mean that's the comment here. Bhushan says I have still not sold Adani stocks. What to do? Average I can hold for 2 years. My suggestion is please don't try to build a layer of decision making on top of whatever is the algorithm output. When the strategy says exit, please exit. Do not wait even for 1 day. So my suggestion would be do not hold. Please get out of these and look at the strategy. In case you want to create your own strategy on top of the strategy, that is fine. But I would not recommend holding on to any particular stock which has been discarded by the strategy. Ajay says, I've invested in multiple small cases. Sometimes during rebalance, the same stock is sold from one small case to another. How does one go about it? Will it constitute intra trading? It's a good question. This will happen very rarely, but it does happen. I will not say that it doesn't happen. But my sense is that the frequency of this happening would be extremely low because most of these strategies are in isolation unless you have bought two small cap strategies or two small and mid cap strategies. If you had one from each cohort, it would not happen. But yes, if there is a situation where one is selling and one is buying, it will be taken in as a intraday trade. But your original trade will continue to have that short term benefit. So if you had bought in one and you're selling now and buying in another, that will get scored off as an intraday trade, but your original will continue to go in as a short term capital gain. So I think there's nothing lost as such in this entire chain of events. DJ says, my lesson is whatever you make in momentum will be given back to market when the momentum goes away. No, I don't agree with that at all. You can see the net result of these strategies over 5 to 7 years. They are still beating the market very handsomely. So this statement is completely wrong. Data Speak says, why don't we include gold in all cap strategy like MIMT all cap? So we could do that, but that would create a new strategy altogether. So originally, due to a legacy of the original design, we don't want to bring in gold into any existing strategy, because then if you 100 people may say that no, we don't want gold in our bouquet, or some may say that we are doing gold allocation as a larger asset allocation on the side, so we don't want to mix equity with gold within the strategy. So every portfolio, every investor has a very different way of how they're allocating to gold. We have MI Evergreen and NG50 as two vehicles where you can have some exposure to gold. But to bring in gold into existing strategies probably is not a good idea. But of course, on the side, as I say often, you must invest and have a hedge within the gold and allocate to gold. No doubt about it. Pratik says buy high, sell higher concept strategy is not working well. I agree with you, Pratik. Nothing is working well in this kind of market. So we will wait for our kind of market to come, and then it will perform, because without the market going up, no strategy can really perform in terms of long only. When should we add lump sum is Shubham's question. So my gut feel is that lump sum should be added on drawdowns, and drawdowns should be meaningful. So 10 to 20% kind of a drawdown is a good area where you can consider a lump sum investment. So for instance, market is now down 10-15% from the top. That is a good point to do a lump sum. So I mean, there is no absolutely right pinpoint answer to this, but this is what I would do in my own strategies also. He says NNF10 has made a new all-time low. So that may have been the case since you have joined in. I mean, let me show you the NNF chart. So NNF10 has fallen from a high of 370, now at 268. It has gained from 100 to 268 over the period. But yes, in the current year or so, it has fallen down. So all in the sense you're saying, should I go all in, is to, it's a good point to add for sure. Whether you should go all in terms of sell out everything else that you own and go into NNF10, that I'm not going to recommend, and that I cannot recommend as per my license also. But yes, this is a good point to add to the strategy. You can see here we were at the same point in June 2022 also, and from June 22 when the market rally actually came, within 6 months you reached 370 from 260 or 270. So 40% gain came in a very short period in that time also. And that can happen anytime again as well. Mohinder says your small case, which are based on Nifty 50 and Next 50, FN Next 50 do not make sense, because your selected stocks may not have enough weightage to overtake the index gain. Please explain if I am wrong. So again, I would say that these are all very well tested strategies. They have been thoroughly tested out. The current period of some flatness in the market is not the only period that we can benchmark it against. So over a period of time, MI India top 10 has also gained. Yes, it is in a flat period also along with the Nifty for some time, but you can see that the gradual increment that the strategy is gaining, if we compare it to, let's say, the Nifty, you can see that the incremental advantage of being in the strategy keeps increasing by some margin. What was margin was there in 2020, now the margin is much more in terms of the beat over the Nifty. So this the whether it makes sense or not is something that I really cannot debate, but I can show you on the data that both strategies, Nifty 50 as well as Nifty Next 50, do make sense, because they have been beating the benchmark by a reasonable
Alok,
margin.
I have a quick suggestion. I mean, since we have a long queue of questions, let's take them selectively, and let's take the ones that are relevant. We see a lot of comments as well. We can take only the
Okay, so let's
questions.
go to questions rather than comments.
Yeah.
Okay. Uh, Sachin says, in rebalance, should we stick to suggested equal weight for all stocks or just make change for additional removal of stock? So in rebalance, of certain strategies like NNF10, the weights are rebalanced to equal weight. But that is not the case in all strategies. Only top 10, evergreen, and uh, NNF10 have this feature. Other than that, all other strategies will not have a equal weight. If some stock has gone from 4% to 6%, it will be allowed to stay at 6% and grow bigger. That's what I'm saying. So everything is not set down or set back to equal weights is the answer for this. Shubham says, I'm combining NNF10 and MIMT all cap. NNF10 and MIMT all cap and planning to take up ATH once there's stock momentum. Your views on it. So it's perfectly fine. MIMT all cap and ATH may have some overlap along with NNF10. That is the only thing, because you're all, the NNF10 and ATH large likely will have large caps and mid caps, and MIMT all cap will also have likely large caps and mid caps more than small caps, because MIMT all cap requires a lot of volume also as an average volume for selection. So what you can do is you can go to the website here, also see analytics and combination here. So you can choose, which strategies you want to combine with what allocation. So maybe you can play around on this page also and see what kind of results this may show you once you submit that. So those kind of things are able you'll be able to see them on the website and take the call on that. Okay, let me look at more questions. So sorry. Baljit Singh says, right now many good small cap stocks are down 30-40% down. Is the right time to invest in small cap, or should we wait? So if you're asking as a discretionary investor, then of course yes. As a stock picker, maybe it's a stock picker's market, where you could, if you have enough information or knowledge about a particular stock and feel confident about it, definitely you can buy it. But my suggestion would be that you have a proper strategy to follow, because just the fact that there are so many X percentage lower from all time high, that need not be the good criteria for buying. So if some stock, let's say, is worth, let's say, 100 rupees, and it has gone to 500 for whatever XYZ reason. Let's say Adani stocks have also gone, or some other. Why just Adani? I mean, there are so many stocks which have gone down 60 to 80% from the top. Even BSC is down, CDSL is down, Polyplex is down. I mean, I can rattle off hundreds of stocks which are down more than 50%, and still, when I see value investors talking about them, they are still saying that it is still beyond fair value. So just the percentage drop may not be the right perspective also. But in case you do feel confident about some stocks, definitely it's going to be a stock picker's market as we go along. We, of course, as a momentum player, will wait for momentum to form, and once momentum is in full force, then we will be allocating. Our strategies mostly are also allocated between, I would say, except MIM MT all cap, between 60 to 80% are allocated. MIMT all cap being a very longer term, more slower moving animal, it will make sure that the momentum is on before it gets on, and it will get off late. So it has both those features of lower churn, etc. Aman says, do you have any plans to launch new small case product with collaboration with other managers? So no, nothing like this is on the table. But what I can suggest, if you like to create such bouquets, you can create bouquets of two managers. So all the index series are available with you. You can plot them on Excel and see whether there is complementarity between any two products, and that can be done actually. Bhupender says, NNF10 subscriber, is it possible to change subscription to MI Evergreen? Next renewal is in November 23. So please drop us an email, support@weekendinvesting.com, and we'll definitely try to help you out here. Casey says, considering the current market situation, what are the broad investments you would suggest we make focus on? So my suggestion would be, do not just rely on equity markets. You will need to have asset allocation. My suggestion for long period has been that please keep allocating to gold. What this 5-10% allocation people suggest is all, in my view, not right. You need to have larger allocation than that. The world is a very uncertain and I would say high risk situation. Equities, no doubt, will do well over a period of time, but I think we need also good hedge and good protection for any unforeseen instant incidents. And for that, my recommendation is that you have a higher allocation of gold also in your portfolio. Ajay says, does momentum work in gold as an asset class? If yes, then what is the need to stay invested in gold all the time? Why not play momentum? So yes, one can play momentum in gold as well. There are global products where people shift from equity to momentum to debt in gold. We don't have as many products available. Neither do we have the liquidity available. So if you want to move 50, 100 crores of gold out of gold into equity, we don't have any product available in the Indian market for that. So the drawback that we have is availability of proper instruments. But yes, it is possible to do. It is definitely possible to do. I as a personal opinion, see gold as a allocation. So it's like an asset allocation, just like as equity is an asset allocation where even if markets are not doing well, I don't want to remove that allocation from equity. It may remain in defensive stocks, it may remain in liquid bees, but I want to keep that allocated towards the market. Just the same way I want to keep some money allocated towards gold and not play around in terms of trying to time it. So I'm not a great timer of things, and that is my limitation, and that is why all these products came into being in the first place, that they automatically allocate and reallocate from cash, etc. The question is, why did you decide on monthly rebalance for IMI India top 10 and non-weekly rebalance? The answer is simple, that we want to keep the churn limited. The higher churn that comes around with weekly rebalance can result in lower returns and higher transaction costs. In some of the strategies where weekly rebalance is there, the returns over a longer period are high enough to take care of these costs. But as you grow towards the higher end of the stocks, Nifty next 50, that is where the weekly churn makes it a little difficult for cost to be justified. Faiz says, can we reach out to get advice on how many strategies to invest in? I feel like I've spread myself too thin between four and want to pare down. So you can reach out to us, but I think the best way would be if you can come to this page and look at all the analytics and decide which ones you wish to keep. My suggestion, because we really cannot advise on individual basis, that is not as per our license. But in general, what I can say is that please see the allocation where each of the strategies are focused towards. And if you have a good coverage of small caps, mid caps, large caps, or some niche like ATH, I think that is a very good combination to have. Chintan says, do you recommend SIP during bear markets like the one we are in, or do you suggest start accumulating capital and then invest as the market starts to? So I think SIPs are very fine. There is no need to stop SIPs and try to time. Uh, if you get some lump sum amounts that you wish to invest from time to time, then of course maybe you can wait for some drawdowns as a trying to time the market. But in general, I would say if you can convert those lump sums that you get also into SIPs over a period of time, that probably is the safest way to go about. Ranjit says, in a hypothetical situation in future, what happens to gold ETFs if the Indian government has asked everyone to surrender them for market trade at that time? Gold as a hedge becomes meaningless, right? You are absolutely right, Ranjit. If the government as a hypothetical situation, says that sovereign gold bonds, we are changing the law and we are going to redeem all the sovereign gold bonds on this and this date, and all the holders will get the price of gold on that date, you really will not be able to do anything. So that is something that that risk is something that we have to live with. So keep your gold segregated and spread across physical ETF and sovereign gold bonds also. That would be my small suggestion. Anupam says, one basic query: if I opt for evergreen of 20 stocks and after my initial investment, if I want to do SIP of around 10K, how it gets rebalanced with the fact that it cannot purchase all of it? So what the small case algorithm does is that it will try to bring your small case as close as possible to the model weights. So it will look at stocks where, if the model weight is 4% and your weight is 3.6% and other weights are okay, it will try to allocate to that stock first to try bring it back to model weight. So sometimes it may happen that a stock is falling and it will allocate more to that, but that is the design of the small case algorithm. But over a longer period, this will even out. So we really need not worry about exactly how it is allocating, because over a period of time you will invest into some gaining as well as losing stocks. Siren says, recently started the MIMT all cap. What would you recommend regarding say weekly or monthly, or invest more every month? It seems small case has raised fees for invest more 100 rupees. So I would feel that if you can do it on a monthly basis, it will be better, because the fee that you are talking about is something that can be avoided, and a monthly frequency for bringing in more money, I think, is reasonably good instead of weekly. But if you can do it weekly, in terms of more evening out of the different levels at which you buy, that of course is an advantage, but I think monthly is also quite good enough. So Apurv Sharma has a question: how can you justify renewal fees even after so much losses? So Apurv, we are not charging you a fee just for this year. The fee is essentially a continued process. So we have charged you the same fee when we delivered very good results, and we are charging you the same fee regardless of what outcome is there. The fee is not really linked to the performance as such. I mean, the percentage based fees that a lot of advisors charge of 1% or half percent or 2% or whatever it may be, that of course is a direct percentage charge on the fee. But yes, I take your point that in a year where the strategies have not performed, the fee should at least make sure that the coming years are better than this. This is all I can say on that. We've tried our best from our side to create discounts, and for those people who are continuing with those strategies, to make sure that they are able to do it for a long term basis. But yes, on a year on year basis, this is not possible to do. In fact, SEBI also does not allow us to not take fee actually. If you read the SEBI charter, we cannot give these forces for free, these strategies. Is it possible to change from one? I think we have already answered that. Ashish says, I'm considering to try small case. It is advisable to have a separate. So if you're already having a demat account where your investments are there, and you don't want any stock that is bought or sold in this small case to impact your long-term tax planning for whatever you're holding, then yes, it is advisable that you have a separate demat account. But even when you do that, on a global basis, I mean, in terms of if you do proper accounting, it will be seen as stocks bought and stocks sold in the same year. So really, there is no way to avoid that taxation issue if that is what the intent of the question is. But if it is just to sort of keep it accounting clean, that these are the stocks from small case and these are the stocks from my original investing, that I think is a good thing to do. Says, is it possible to make absolute momentum version for MI20? So MI20 is a rotational momentum strategy for the benefit of others, where 20 stocks get rotated. And if you actually see MI20, which is somewhat like MI30 in terms of absolute. So if I show you that MI20 has actually done better than MI30, which is the absolute strategy. So since this year and a half that market has been flat, I would say that rotational strategies have done better than absolute strategies, because the fall and the rise have been within a range. Had they been extremely sharp down periods or sharp upsides, absolute would have performed better. But because it has been range bound, absolute has been hit a bit, and rotational have done better because they're already always invested in those stocks. So I think with this kind of a background, MI20 in the current format actually is doing quite well. Shared as a question. Do you think there would be continued impact from ongoing banking crisis firing in IT? So, okay, this is a bit of a philosophical and a forecasting question. I'll give my best thought, but I don't hold myself in very high regard in terms of trying to forecast things. My sense is that the crisis is continuing. The global situation is pretty delicate. We've been able to avoid some bank failures by very quickly doing some bandage on the damage. Interest rates are already at 5%. Inflation has not reduced. Employment rates have not gone down. So the purpose of increasing interest rates have not been met. So the Fed is in a way trapped. Now, if they increase interest rates more things will get broken down. More institutions will come at risk, because a lot of folks are sitting with bonds at 0% interest rates. So it is a very sticky situation where anytime anything can go wrong, and with ammunition running out of what to do, maybe there will be some out of the box, or some very aggressive solutions being thought of, maybe war or something like that by the US machinery. So I think there is crisis that is continuing. We in India are quite insulated from that crisis largely, but I think from a market perspective, until that crisis is contained, we will not really start our journey upward. We are hence simmering just 10% below all-time highs on the indices, because of this reason only, that our markets per se are not structurally damaged like a lot of other markets are. So we are waiting for just some calm and peace overseas, so we can take off. And of course, the time correction and everything is happening after that ferocious 150% gain in 18 months. So IT, I think, from the little I know, IT, I've talked to a few people in IT, and they do say that the impact of AI over the next year or so will be meaningful, and that I think can impact IT, Indian IT as well. Um, I don't have any more expertise to talk about this, so I'll just shut up on this. But I can only say that despite the IT stocks being where they are, in several of our strategies, we are finding some mid cap IT stocks doing extremely well. So until there is price action on them, we will continue to follow them. Arshad says sometimes the realized loss in small cases for the month is way higher than SIP amount, so SIP is wasted. So no, we cannot view it in this way that SIP is wasted. SIP is something that you are disciplined way of coming in. There will be months where that month will be good. There will be months where that month is bad. So don't equate that SIP with the performance of the entire thing on the month. I think that will be a wrong way to look at it. Blason Jacob says, what happens when we stop the subscription for our existing small case? Can we resume back after a small gap? I think that is very much possible. Please drop us a email. We will definitely connect with small case team also to make sure that there is a seamless sort of a restart when you want to come in. That should be possible. I just need to check one thing, that whenever you resubscribe, the first investment of the minimum amount may have to be redone. But I'll have to check on that. So please drop us a mail and we'll connect you with a small case on this. So I think this question is already answered. Thank you so much, Siren. I think a lot of folks have written about deep losses. Yes, there are some strategies which are down 10, 15, 20% also this year. But I mean, I don't think you have experienced deep losses then. I mean, in 2008, strategies were down 80%. In 2000, March 2020, strategies were down 30, 40%. In 2015, strategies were down 25, 30%. So I don't think, the current situation is that of deep losses. So, had you, if you have enjoyed those 18 months of 150% gains, where several strategies did even better than that, I think you need to have that context that, 10%, 5%, 6%, 12%, these are not deep losses. If you consider them deep losses, then, uh, I don't know what happens in case we go, just like 2008 or some other thing like that. So please have that context in mind. Yes, we are in a period of frustration. I can sense a lot of folks are not happy about things, and that is natural because some of you have not seen long bear markets and deeper bear markets. But I can tell you this much, that as and when markets recover, as and when momentum recovers, and as and when market starts to structurally go up, you will find most of these losses will get covered in very short period of time. This is the nature of the market and the nature of the strategies that we run. So we are down to the last minute and a half. Let me also go and see if we have any questions that we can take up, which can help others also. Uh, so what says backtesting is only till 2016, which is less time period. Have your strategies worked earlier as well? Strategies have worked earlier as well. We don't want to go too far back in the past, because very long backtests also become meaningless as the structure and the stocks in the markets have changed. So, when we started in 2016, we did offer, backtest studies into even 20-year study we did. I think I remember on all cap or ATH. I don't remember, but the results have not changed much because these are low frequency strategies. Once a week, once a month, that type of structure is not changing much. What has changed is what happens in a day, what happens in an hour, what happens in 5 minutes. That is something that has changed more because of algorithms, etc. So from that perspective, the backtests have remained reasonably sanguine, and that has not changed much. But going too far back into a backtest of 90s and early 2000 does not make too much sense anymore. And also the fact that all the backtests that we have done are survivorship bias free. So when we go 20, 10, 15, 20 years back to find survivorship bias free data, which means that exactly those components of the market that were existing at that time, to do a backtest using them is very, very difficult, because that data is usually not available for 15, 20 years back. A lot of rights issues, bonuses, stocks getting distinguished, stocks getting bought out, stocks getting delisted, all that has to be assimilated there. So I'm at the end of today's 1 hour. I'm very sorry if I have not been able to take your query. You please write to us at support@weekendinvesting.com, or you can come to this YouTube live again at the end of next month. We will do this again, and I really have no more thing to say regarding that. I can assure you that if you stay invested in the markets, if you stay with this particular strategy that has performed, you will do well. Try to see the market in a longer view. Every year cannot be a gain year, every month cannot be a gain month. There will be long periods of pain also in the market. That is unavoidable. This is the nature of the game that you need to really play along. So with this, I want to bring this meeting to an end. Thank you so much for joining on a Saturday afternoon. I'm very appreciative that so many, more than 120, 130 people have joined this, and we hope that Weekend Investing will remain your favorite research entity, and we will be able to deliver the results in a good market as well. So thank you so much. Goodbye.